Jacob T. Davis here, Woodbridge Real Estate with
Jared Evanson here, Cross Country Mortgage. What is going on, Jacob?
What's Happening.
What's going on?
Like your T-shirt. Did you notice that mortgage is upside down on your T-shirt?
No, it's not. Oh, you know why it's that way?
Why is that?
So when I look down, I can actually read it and know what I do for a living.
Yeah, makes sense. Makes sense. Remind you what industry you work in.
Something's got to keep me straight sometimes. Absolutely. Well, what are we doing today, man?
Well, so
What's
I've
this?
been working on, so I've got a builder that wants to market that they're willing to pay an interest rate buy down for a home in their neighborhood. So 610 Southwest Waha in Sundance South and Pullman. And so I wanted to let people know that builder will buy the rate down and just get your take on what that looks like.
Awesome. So there's a couple different ways to do a buy down, and I love seeing when builders are offering these incentives because it goes a really long way for a buyer, right? Um, there's two ways to do a rate buy down, and I always suggest in a market like the one we're doing, where interest rates are already kind of high, is looking at temporary rate buy downs where we're on the verge of, fingers crossed, a period where interest rates are headed down. They're headed back in the right direction. So a year from now, maybe we're looking at rates that are a lot better than what we're seeing today. So that's why I'm a big fan of a temporary interest rate buy down instead of a permanent interest rate buy down. So the difference is, on a permanent interest rate buy down, your money isn't going to go as far for you in the short term. So, $13,000 on a permanent interest rate buy down might save you, call it or $200 a month, right? So, and I would have to look at a whole bunch of things to figure out the exact numbers. Whereas you can take a temporary interest rate buy down with the same amount of money and save more, but the difference is it's only for a couple of years. So I like to use the example of the most popular one, that it's called a 2-1 buy down. And what that means is we will take your interest rate. So you'll lock in at today's current interest rates on, like, let's say a 30-year mortgage, and you will save 2% off of that mortgage rate in your payment for the first year, and only 1% off of that rate for the second year. So I've actually got a demonstration, or an example that I put up on the house on 610 Southwest Waha that you were talking about. I'm going to pop it up real quick. So let's go that one right there. So everybody, raise your hand if you can see the screen there in the back. Okay, looks like everyone can see it. So the example I put up here is so that one on Waha for $735,000. So the example I'm using, the buyer is putting 20% down payment. Now, you don't have to do a 20% down payment to be able to get a 2-1 buy down. However, it does affect the cost of it, right? Because smaller loan amount means the buy down is going to cost a little bit less. So most people buying in this price range are typically putting about 20% down. So I'm using that as the example. The interest rate that I'm using here is a 6.75% interest rate. I'm not quoting that rate. I'm not saying that that's what every buyer that's on this house would get. I'm just saying, I'm using this as an example to get things started. If I was quoting a rate, I'd have to, put a bunch more information in there, and that's not what we're doing here. But so if you had a $735,000 purchase price, 20% down, which is a $588,000 loan, and you had a 6.75% interest rate, you would have a monthly payment. And now this is just principal and interest. I'm not factoring in property taxes or homeowners insurance here, but that would be $3,813 for the principal and interest on the mortgage. Now, this is what's really cool. So on that 2-1 buy down, The very first year, remember, you're going to save 2% on that. So instead of a 6.75% mortgage payment, or your payment being based off 6.75%, for the first 12 months you have a payment 4.75%. That is almost $750 a month savings. It's just a couple dollars shy of that. So your principal and interest payment goes down to $3,067 for that first 12 months, which that's awesome. Is you are getting, accustomed to your new house payment or whatever. Everybody wants to save money. So that's almost $9,000 for the year in this scenario. So the next scenario, or excuse me, the next year. So year one, that's your payment. The next year, it goes up to 5.75, right? So again, the normal payment on that would be about $3,800. We're going all the way down to $3,431 for the second year. So that's $382 a month savings from your note rate, which is about $4,500 for the year. So it's about half of what you save on the first year, probably exactly half. And then in year three, so after those first 2 years, if you are still in this mortgage, a lot of people will probably have an opportunity to refinance out of this before the first 2 years is up. And we'll tell you what happens in that scenario. But after those first 2 years, then you go to your fully, maturing $3,813 payment. So awesome way to save money. If I was had a builder offering an incentive for me, this is exactly what I would want done with the money.
So if let's say the buyer wants to refinance in 12 months, hopefully interest rates are in the mid fives within 12 months, but who knows at this point. But let's say we're in July or August of next year, and I want to refi into a 30-year fix. So what happens then?
So that's a good question, because a year from now, you'd only be 1 year into this temporary interest rate buy down, right? So, you'll see on my little chart here, it's the cost for a 2-1 buy down. This is what the builder basically is subsidizing your payment for. In this scenario, it's about $13,545. So every month we're taking from that pool of $13,545. Now, this money will never go to waste, because we take out of that pot every single month. And if you were to pay this mortgage off or refinance it, we are going to deduct the amount owed on the mortgage. Or what's left in this account from the amount owed on the mortgage. So let's just say it was after 1 full year. After 1 full year, you're going to have $4,588 left in that account. So if your mortgage payoff after 1 year is $575,000, we're going to deduct your mortgage payoff by that amount, so that money doesn't get wasted. So instead of 575, you got about 570,500. So it lowers how much you owe. So that money will never get wasted.
So if let's say we're month nine, the ninth month of the 4.7% period, and I want to refi, do I get the 3 months for the first 12-month period back as well?
Yeah, so that's about an extra $2,200 or so on top of so you would get about $6,800 back there. Yep.
Can I
So
can I use that money and go to Vegas or go to a bowl game, a Coug bowl game?
you're going to go to the bowl game anyway, but which probably the Rose Bowl this year, let's be honest. But so that money, it can only be applied towards your payoff. So now let's say you're refinancing, though, it's going to just basically get applied to the bottom line. So if you wanted to buy your rate down a little bit, kind of like in some way, shape, or form, we're kind of applying, that extra money towards, just the bottom line. So your closing costs for your new refinance, buy your rate down, or say you won the lottery and you just want to pay it off. We're going to cash it off towards that. We are not, though. We can't give you a check for cash for that difference. So it goes one way or the other. So either towards the payoff
Most
or
likely it'll go towards a long-term refi.
Yeah, I think so. That's what kind of what I would do. Yeah, at the end of the day, it's it's gonna wash out any costs you have on your refi. So it almost, yeah, it could make it. I don't want to use the word free refi, but it's gonna cover a ton of the cost there. So uh, definitely, the sooner you're able to get out of it, the better. Because in a case where it's saving you money, or the closer to that bottom rate, the better. So, because then you have some extra money to use towards those costs. Sure.
So in my mind, there's no reason to wait for interest rates to drop if a builder's willing, or if any seller is willing to do this 2-1 buy down. I mean, it's almost like you got some interest rate insurance there. Like you're getting a 4% interest rate, and then if rates do drop in the future, you still can refi. Plus, you get some money to go towards that refi.
Yeah, no, that exactly. There's so much you can do with this, because you can. I mean, you could do a little, if you wanted to take some of your own money and do a little bit of take that 6.75 I talked about there. Let's say you wanted to take it to 6.5, permanent, whatever. But if you think about it, Jacob, just in the last 2 weeks alone, interest rates are over like a 0.5% lower than they were, back in the middle of July. So
Mm.
you're already got some savings right there, monthly savings, and you add this builder incentive on top of it, like you're getting a screaming deal on this house. Here's what's going to happen too: when rates go down, home prices are going up. We know that because more buyers are entering the market, and it's going to create competition. So get in before you see any kind of home prices going up. It's what I
Well,
like.
I think like this house on Waha, I think it could, if we're in a crazy market like we have been in the past, I could see that going for 750 or 8 even. I think the smaller single level homes that I'm selling under 6 are going to be over 6. So in my mind, it's like buy now at today's prices and get tomorrow's interest rate now.
Yeah. Exactly. Like, yeah, to me, I love it. That's what I love about new construction, is because you can do things like this. I think it was in the last, the COVID era, the single level, is this like a no step? Would you call this a no step house? Or the no
I
the
mean,
single,
basically, yeah, there's no
yeah.
steps.
Yeah, the single level ranchers, like I'm up in Spokane, dude. Those were tough. They were tough to get. Everybody wanted it. You'd have builders in these communities that were building lots of houses, and it's like those are the ones that went pending as soon as they went live. It was crazy. It's a cool style of house. A lot of people like it. Um, so it's what I wanted. I don't know why, but anyhow, but awesome incentive. A lot of lenders have the ability to do the 2-1 buy down. Not all of them. There are a few out there that just don't have the technology for it. It's simple as that. But most likely, whoever you're working with probably has an option to do this. If not, just give your guy a call. I'll hook it up. But um, awesome. That's cool that your builder's wanting to do that, because it's a sweet incentive.
Well, that sounds like a good deal. So that's about all I got. I was just curious how this interest rate buy down looks. I think that was some really good detail that you shared there. So thanks for joining on another Coog Real Estate podcast.
That's right. I'm popping this back up here again for you to see. But thanks for having me, Jacob. Looking forward to it next time. I know we don't have any crazy songs to go out on today, but
We should play a little wazoo.
I'm getting so excited. I'm
Yeah.
so excited.
All right. Well, until next time,
Later.
go Cougs.